In case of redemption or in case of winding up of the company, so first payment will be made to the preference shareholders. After that, the payment of capital will be made to the equity shareholders. Equity shareholders will be paid later once the preference shareholders are being paid with the dividend. When the company receives application for more than the actual number of shares which is being issued to the public, so that is known as oversubscription. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram PU College, the Temple of Excellence, Mysuru. My dear students, today we are in the second session of chapter 1 of part B of your accountancy syllabus, and the chapter name is Accounting for Share Capital. So let us quickly recall what we have discussed in a previous session, because we had already discussed few of the concepts. So in my previous session, I had covered this topic, that is, we have discussed what is the meaning of company, next features of company, and different kinds of company. So these are the few topics I had already discussed in a previous session. In today's session, we shall continue with the new concept. So as I've already told you, I'm going to discuss about shares, because this chapter is relating to your shares. Okay, so let us see what is this share. So if you see the meaning of shares, so the total capital of the company is divided into number of smaller units, which is called as what? Share. So the total capital of the company is divided into units of small denominations. So such each unit is called as what? Share. For example, if the company wants to raise capital of rupees 10 lakh. So this is a capital what it wanted to raise. Now this 10 lakh cannot be raised by a single person, or it cannot be given by a single person, because it will be a burden for him. So what the company will do? Company will divide these shares into number of smaller units of rupees 10 each. So it will divide into smaller denominations of rupees 10 each, so that it can be purchased by any of the shareholder. Okay, so these smaller units or these smaller denomination of each unit is called as what? Shares. Now this unit is called as share. Or you have one more definition for share. A share is a share in the share capital of the company. So what do you mean by that? What is share? A share is a share in the share capital. Now, a share is what? It is a part of share capital of the company. So, this smaller unit is called as what? Share. So, as I told you, the famous definition for share is what? A share is a share in the share capital. A share is a share in the share capital of the company. So, that smaller unit is called as share. So, for example, if the total capital of the company is rupees 10 lakh divided into 1 lakh units. So, 1 lakh units of rupees 10 each. Now, this 10 each. So, these units is being divided into 1 lakh units. So, of rupees 10 each. So, each unit of rupees 10 will be called as a share. Now, each unit of rupees 10 is called as share. Thus, the above case, the company has 1 lakh shares of rupees 10 each. So, how they are going to raise their share capital? By dividing that share capital into number of smaller units of rupees 10 each, so that 1 lakh divisions will be made, or 1 lakh shares of rupees 10 each, in order to raise their 10 lakh. Shares must be numbered so that they can be identified. So, shares will be numbered. So, it will be serially numbered so that each and every shares can be identified. So, hope you are clear about the meaning of shares. Now, coming to next topic, that is nature of shares. So, the shares of the company are movable property, that is transferable in the manner provided by the Articles of Association of the company. So, depending upon the Articles of Association of the company, the shares can be movable property, or it can be transferred from one person to another. Shares of a company are treated as goods under the Sales of Goods Act 1930. So, according to Sales of Goods Act 1930, the share is considered as what? Goods, because it can be bought as well as sold in the market. So this can be bought as well as sold in the share market. So it acts as a goods. So this is about nature of shares. Now coming to types of shares, so under section 43 of Companies Act 2013, a company may issue two types of shares. So what are the main two important types of shares? So the first one is preference shares and the next one is equity shares. So these are the two types of shares. One is preference shares, other one is equity shares. Now let us see what is this preference shares and what are the conditions and what is equity shares. Now coming to the first type, that is preference shares. Preference shares are those which has the following two rights. Let us see what are the rights which are included under preference shares. So they have a right to receive dividend at a fixed rate before any dividend is paid to the equity shareholders. So as I told you, there are two types of shares. One is preference shares, other one is equity shares. So here the word itself says that preference, in the sense the first preference will be given to preference shareholders rather than equity shareholders. Okay, so they have a right to receive the dividend at a fixed rate. So here the dividend means what? The return on preference shares or the return on equity shares is called as dividend. Okay, so under preference shares, here they are going to receive fixed rate of dividend and the first preference will be given to the preference shareholders. So here the payment of dividend will be made first to preference shareholders, then remaining amount will be paid to the equity shareholders. Okay, and the rate of dividend will be fixed rate of dividend. When a company is wound up, they have a right to return of capital before that of equity shares. So in case of winding up of the company also, preference shareholder will be given the first preference while returning back their capital. Okay, in case of dividend also and in case of returning of capital also, preference shareholders will be given the first preference. So it is called as what? Preference shares. And one more thing you have to remember is it has fixed rate of dividend. In addition to the above, the preference shares may carry some more rights such as right to participate in the excess profit when a specified dividend has been paid on the equity shares or the right to receive a premium at the time of redemption. Other than these two rights, this preference shareholders has few more rights like right to participate in the excess profit, that is after the payment to the equity shareholders, if there is any excess profit that goes for preference shareholders, and a premium at the time of winding up, that is a premium at the time of redemption, that is while payment or while paying back of the capital or while paying back of the amount to the shareholders. So first preference will be given or the premium will be given to the preference shareholders. So this is about preference shares. Now coming to the next type, that is equity shares. So let us see what is this equity shares. So how the rate of dividend will be, whether it is fixed or fluctuating in nature. Now equity shares are those shares which are paid dividend only when profit are left. So when they are going to pay the dividend, only when the profit is left, then only the equity shareholders will be paid the dividend. After the preference shareholders have been paid fixed rate of dividend. So as I told you, whenever the organization earn profit, so first payment will be made to the preference shareholders and after that if any amount is left, then the equity shareholders will be paid. In other words, there is no fixed rate of dividend on the equity shares. So here they don't get any fixed rate of dividend like preference shareholders. If in a particular year there are no profit or insufficient profit, the equity shareholder will receive nothing. So what is the main disadvantage of equity shareholders? If there is excess profit, then they will get excess dividend, because in equity shares there is no fixed rate of dividend. So when the organization earns more profit, then the equity shareholders gets benefit that they will get more dividend. But if they incur loss, then what happens? These equity shareholders will not get the dividend at all. So that is a main drawback of equity shareholders. If the company earns more profit, they get a higher rate of dividend. So as I told you, if there is excess profit, then higher rate of dividend will be given to the equity shareholders. As regards return of capital, equity shareholders is returned only when preference share capital is returned in full. So in preference shares, we had already learned that. So in case of redemption or in case of winding up of the company, so first payment will be made to the preference shareholders. After that, the payment of capital will be made to the equity shareholders. So here the payment is made only after the payment which is being made to the preference shareholders. Equity shareholders has a voting right. So one more advantage of equity shareholder is that they have the voting right while selecting the directors of the company. That is board of directors. But in case of preference shareholders, they do not have any voting right. So equity shareholders have voting rights and control the affairs of the company. So they have a right to control the affairs of the company. So this is the meaning of equity shares. Now coming to the next topic, let us see what is the distinction between preference shares as well as equity shares. Now if you see or you have already learned the meaning of equity shares and preference shares, so you'll be able to identify a lot of difference here. Now go through the difference between this equity shares and preference shares. Now coming to the first one, under basis we have rate of dividend. So how the rate of dividend will be there under equity shares and how the rate of dividend will be there under preference shares. So under equity shares, the rate of dividend on equity share is not fixed. So here it is not fixed. It may vary from year to year depending upon the availability of profits. So as I've already told you, if there is excess profit, equity shareholders will get that benefit because they will get higher rate of dividend, because there is no fixed rate of dividend for equity shareholders. But while compared to preference shares, they are paid at a fixed rate of dividend. So whatever may be the situation, they will get the fixed rate of dividend. Now coming to the second difference, arrears of dividend. So in case of equity shares, dividend cannot accumulate. Suppose in a particular year they have incurred the loss, then equity shareholders will not get anything. Okay, so those dividend cannot be accumulated for the next year. In the sense, those dividends, suppose in the first year they had to pay the dividend of rupees 10,000 and the company has incurred loss. In that particular year, they will not get anything and that 10,000 will not continue for the next year. That is in case of equity shares. But in case of preference shares, if dividend is not paid on these shares in any of the year, then the arrears of dividend may accumulate. So, since they are getting fixed rate of dividend in one particular year, the company could not pay the dividend to preference shareholders, then that dividend will be paid in the next year, will be paid when the company earns sufficient profit. So, it will accumulate for the next year. Next one is preferential right as to the payment of dividend. Of course, when compared to payment of dividend, who will get more preference? That is preference shareholders. So, payment of dividend on equity shares is made after the payment of preference dividend. So, as I've told you, equity shareholders will be paid later once the preference shareholders are being paid with the dividend. So, they are, or if you see the preference shares, they have a right to receive dividend before any dividend is paid to the equity shares. So, before payment of equity shares, so the first preference will be given to the preference shareholders, and if any amount is left, then only the equity shareholders will be paid. That is, second preference goes for equity shareholders. Now, coming to the next one, preferential right as to payment of capital. In case of capital also, if there is any excess amount, so first capital will be paid to the preference shareholders. Then if any amount is left, then the payment will be paid to the equity shareholders. So, equity share capital is paid only when preference share capital is paid out fully. Only once the preference shareholders are being paid, then if any amount is left, then the equity shareholders are being paid. So, if you see preference shares, they have a right to return the capital in case of winding up. That is, in case of winding up of a company, the capital of the preference shareholders will be settled first, then later on they are going to settle the capital of equity shareholders. So, in case of winding up, before any capital is returned to the equity shareholders. In the sense, first preference will be given to the preference shareholders. Next, voting rights. So, how will be the voting rights? Equity shareholders enjoy voting rights. So, they have a right to vote and select the board of directors. But for preference shareholders, do not have any voting rights. So, they don't have any voting rights. And the next one is right to participate in the management. So, who has right to participate in the management? So, they have full right to participate in the management of the company. Who? That is equity shareholders has a full right to participate in the management of the company, whereas preference shareholders, they do not participate in the management of the company. Okay. So, these are the difference between equity shares as well as preference shares. Now, coming to the next topic, that is share capital of a company. So, what is the share capital of a company? The amount collected by the company from its members, that is shareholders, is called as share capital. So, as I told you, so whenever the company wants to increase or whenever the company wants to raise the capital, so what they are going to do? So, they will decide that the whole capital is being divided into number of smaller units. Then what is share capital? The amount which is being collected from the shareholders by issuing shares. So, that amount is called as share capital. So, the amount collected by the company from its members or shareholders is called as share capital. For accounting point of view, share capital is known by different names in different stages. So, share capital, you know share capital means what? The amount which is been collected by the shareholders by issuing shares to the public. Okay. So, from the accounting point of view, we are going to call from different names. So, let us see what are those names. So, the first one is authorized capital. So, what do you mean by authorized capital? It is the amount of share capital which a company is authorized to issue. So, the amount which is been authorized to issue by its memorandum of association. So, in the memorandum of association, what the company have decided to authorize to issue to the public, so that amount is called as what? Authorized capital. It is also called as nominal or registered capital. So, this authorized capital is also known as what? Nominal or registered capital. Next one is issued capital. It is that part of the capital which is being taken from the authorized capital. So, authorized capital means what? In the memorandum of association, that is one of the important document of the company, that is memorandum of association. So, in the memorandum of association, what the company have decided to raise the capital, that is called as authorized capital. Then what is issued capital? It is that part of authorized capital which is actually issued to the public for subscription. Suppose the authorized capital is 10 lakh and they are going to issue how much? Only 9 lakh. That is the actual amount or the actual capital which is been issued to the public to subscribe. So, that is known as what? This 9 lakh is called as issued capital. Next one is the remaining part of the authorized capital is known as unissued capital. That is remaining 1 lakh is called as what? Unissued capital. So, which can be issued later on. So, hope you are clear with authorized capital as well as issued capital. That is the actual capital which is being issued to the public to subscribe its shares is called as issued capital. Next is subscribed capital. So, it is that part of issued capital which has been actually subscribed by the public. So, suppose if the company issues 9 lakh shares, 9 lakh worth shares to the public, it doesn't mean that whole 9 lakh worth shares has to be subscribed by the public. So, they can subscribe just 8 lakh also. So, this is known as what? Subscribed capital. So, it is that part of issued capital which has been actually subscribed by the public. If say rupees 13,000, that is, if say 13,000 shares of rupees 100 each are offered to the public and the public applies only for 12,000 shares, the subscribed capital is 12 lakh. Okay, so here they have issued 13,000 shares of rupees 100 each, but how much the public have subscribed? Only for 12,000. Then this 12 lakh is called as what? Subscribed capital. Next one is called up capital. It is that part of subscribed capital which is called up on the shares, which has been actually called. So it doesn't mean that shares has to be called up fully. So it is that part of subscribed capital which has been actually called up by the company. So that is known as, it is how much the company have told the shareholders to pay. So that is known as called up capital. Next one is paid up capital. It is that part of called up capital which has been actually received from the shareholders. So suppose if the company have called up rupees 5 on particular share, but it doesn't mean that whole 5 will be paid up by the shareholders. So they might pay only rupees 3. So it is part, then what is paid up capital? It is a part of called up capital which has been actually paid by the public. So how much the shareholders have been actually paid? Only rupees 3. So this is known as what? Paid up capital. Next, the public company. So if you see about issue of shares, that is how they are going to issue the shares. So a public company collects amount from its shares by offering shares to the public in easy installments. So suppose if the whole share amount, that is a particular individual share amount is rupees 100. So the company need not tell the shareholders to pay 100 at once. So this 100 rupees can be paid in the form of installment, like 50 rupees, 30 rupees, 20 rupees. So there are different stages where the company will tell the public to pay the amount, which is called as what? Called up capital. But what the amount the shareholders is going to pay, that is called as paid up capital. Okay, so a public or from the public or a public company collects amount from its shares by offering the shares to the public in easy installments. So there are certain installments, so they will not force the shareholders to pay the lump sum amount. So in installment they are going to pay. So if you see the first one, first installment is application money. So there are different installment where the first installment where they are going to collect is application money. For example, if the share value is rupees 100. So in the first installment they will tell just to pay rupees 50 as application money. And the second installment is allotment money. So where they will ask to pay rupees 30. So here it is 80. Okay, and remaining installment, first call, second call and so on. So there may be number of calls. So where they'll tell the shareholders to pay the remaining amount. So remaining amount is 20. So wholly it is 100 rupees. So 50 on application stage and 30 on allotment stage and 20 on call stage. So these are the installments. So shares of the company are issued either at par, at a premium or at a discount. So what do you mean by at par? Suppose if the share value is rupees 10 and it is being issued at rupees 10 only, then it is known as issued at par. Then issued at premium means what? The value of share is rupees 10 but they are going to issue at rupees 12. So this 2 rupees, this rupees 2 which is been over and above the nominal value of the share, that is called as what? Issued at premium. And at discount means what? So suppose the value of share is rupees 10 but they have issued at rupees 8. It is lesser than the nominal value, then it is called as shares at discount. So this is about the company can issue the shares at par which is equal to the nominal value. It is 10 means the par value will also be 10. Par means equal to the nominal value, premium means more than the nominal value and discount means less than the nominal value. So when the issue price is exactly equal to their nominal value, that is face value, it is called as issue of shares at par. So I have already told you, if the 10 rupees share is issued at rupees 10 only, then it is called as issue of shares at par. So when the issue price of shares is more than the nominal value, then it is termed as what? Issue of shares at premium. So premium means what? More than the nominal value. So if you see the example here, the share value is rupees 10, but they are going to issue at rupees 12. So that more than the nominal value is called as premium. And when the shares are issued at a price less than the face value or nominal value, it is known as what? Issued at discount. So here the 10 rupees share is issued at rupees 8, then rupees 2 is what? That is discount. So hope you are clear about issue of shares. Now, if you see few more terms here, so we'll come across prospectus. So in the previous session itself, I have told you what do you mean by prospectus. So prospectus is an invitation to the public to subscribe for the shares of a particular company. Suppose if there is a company and it wants to raise the capital by issuing shares, so what it will do? It will issue prospectus to the public telling that to subscribe the shares of that particular company. So it's just like an invitation to the public to subscribe the shares. So what is prospectus? A prospectus is an invitation to the public to purchase its shares. It contains a complete information about the company. So as I told you, it's an invitation to the public to subscribe its shares. So it contains all the details about the company. Next, calls in arrears. So what do you mean by calls in arrears? When any shareholders fails to pay the amount due on the allotment or any of the calls, such amount is known as calls in arrears or unpaid calls. Suppose the share value is rupees 10, that is individual share value is rupees 10, where it has been divided as 5 application, 3 allotment and call 2. Okay. Now, a shareholder have paid application money but fails to pay allotment money and call money. So this is known as what? Calls in arrears. So if the shareholders have failed to pay the allotment money or any of the call money, so that is known as what? Calls in arrears. So such amount is called as calls in arrears or unpaid calls. Next one is calls in advance. Now if you see the example here, now in the application stage it is 5 and allotment stage it is rupees 3 and call stage it is rupees 2. Now a shareholder in the application stage he has paid 5 rupees and in allotment stage he has paid rupees 5, that is 3 of allotment and 2 of call. Okay, so he has paid in advance. He has paid the call amount in advance. So that is known as what? Calls in advance. The amount received by the company from its shareholders on the calls not yet made is called as calls in advance. So they have not asked for the payment of call amount only, but in advance a shareholder have paid allotment money along with the call money. So that is known as calls in advance. So that is calls in advance. Now coming to the next term, that is oversubscription. Now what do you mean by oversubscription? When the company receives application for more than which has been actually issued to the public. Okay, so when the company receives application for more number of shares than the number of shares offered to the public for subscription is called as oversubscription. For example, if the company have issued 10,000 shares to the public for subscription, but the shareholders have applied for 12,000 shares. Then this 2,000 shares which is been applied extra is called as what? Oversubscription. So when the company receives application for more than the actual number of shares which is been issued to the public, so that is known as oversubscription. In the same way, under subscription, so if you see the example, same example, 10,000 shares is being issued to the public for subscription, but only 8,000 shares is being subscribed by the public. So that is known as under subscription. So under subscription is a situation where the number of shares applied for by the public is less than the number of shares offered to the public for subscription. Here the company have offered to raise a capital by issuing 10,000 shares, but what did the public do? So they have applied only for 8,000 shares. So that is known as under subscription. So hope you are clear with over subscription and under subscription. Next is issue of shares at par. Already we have discussed. So if the share is been issued equal to the nominal value, then it is called as issue of shares at par. So issue of shares at par means issue of shares at a price which is exactly equal to the nominal value or face value. For example, if the value of share is rupees 100 and they are going to issue at rupees 100 only, then it is known as issue of shares at par. So shares of nominal value of rupees 10 each are issued at rupees 10 per share. So this is also one of the example for issue of shares at par. Next, issue of shares at premium. So already we know if it is more than the nominal value, then it is known as issue of shares at premium. Suppose 100 is a face value of the shares, but they have issued at rupees 120. Then it is more than the nominal value. It is called as issue of shares at premium. So issue of shares at premium means issue of shares at a price which is more than the nominal value or face value of the share. So this 100 rupees is called as nominal value or face value of the shares. If the share is issued more than the nominal value or face value, it is called as issue of shares at premium. In the same way, issue of shares at a discount already we have discussed. Now 100 rupees shares is being issued at rupees 80, that is less than the nominal value, then it is known as issue of shares at discount. Okay, so if you see the example of issue of shares at premium, shares of nominal value of rupees 10 each are issued to the public at rupees 12 per share. So here rupees 2 per share is called as premium. Okay, so if you see the example, 20 rupees will be the premium and here 20 rupees which is less than the nominal value. So that 20 rupees is called as what? Discount. Okay, so this 20 rupees is called as discount. Next is issue of shares for consideration other than cash. Suppose if the company have purchased a machinery, okay, so it has to give in return what? Cash. So they have purchased a machinery and the company has to pay cash. Instead of paying cash, they will issue shares to that person. So that is known as what? Issue of shares for consideration other than cash. Instead of giving cash, they are giving in the form of shares. Okay. So issue of shares by a company to the vendors, that is the sellers from whom it has purchased the assets. So if the company have purchased certain assets like machinery, land, building, etc. So instead of paying cash to them, so they will return that amount in the form of shares. Okay, so purchase the assets such as machinery, building, etc. is known as issue of shares for consideration other than cash. So here instead of giving cash, they are going to give in the form of shares. Hence, no cash is received by issue of shares. So in such cases, company will not receive the cash for such shares because equal amount of shares will be given to the sellers there. So here they will not get the amount. So this is about issue of shares for consideration other than cash. Next, coming to the next topic, that is forfeiture of shares. So forfeiture means what? It is a cancellation of shares. So here, suppose 100 shares is been issued, it doesn't mean that all the 100 shareholders will pay all the amount. Correct? So there are certain shareholders who fails to pay the amount. So such type of shares has to be cancelled. So cancellation of shares is called as forfeiture of shares. So forfeiture of shares means cancellation of rights of the shareholder on the shares held by them for the non-payment of allotment money or call money or both of such shares. Suppose if the shareholder have not paid the allotment money or there are certain shareholders who have not paid the call money, so cancellation of their right on shares is called as what? Forfeiture of shares. So you have an entry to transfer that forfeiture to general reserve. So your entry is forfeiture account data to general reserve account. So being profit on reissue of forfeited shares transferred to capital reserve. So we'll come to know about this journal entry in detail in the next session. Okay, so time being, remember, forfeiture means what? Cancellation of a right of the shareholder for non-payment of allotment money or any of the call money is called as forfeiture of shares. Now, if you see the accounting treatment, so these in your 12 marks problem, you will have all these journal entries. So you have to learn the journal entries properly. So here, as I've already told you, the company is going to issue shares on the basis of installments. Okay, so in each and every installment, what are the entries to be passed? Okay, so that will learn under accounting treatment. So when you solve the problem, you can clearly understand. Time being, go through the journal entries. So in stage of application, so the first entry is for what? For recording share application money received. So what is the entry? Bank account data to share application account, because we are going to receive the amount. So debit bank account through what? Through share application. So your entry is bank account data to share application account. Next, coming to the next stage, that is an allotment. For the transfer of share application money on allotted shares to share capital account. So you are going to transfer share application money to share capital. So what is the entry? Share application account data to share capital account. Next, third stage, that is, so in the second stage itself, that is on allotment, your third entry is for what? For recording the share allotment money due. So what is the entry? Share allotment account data to share capital account. So this is for allotment money due. Next entry is for allotment money received. So for recording share allotment money received, bank account data to share allotment account. So this is for allotment money received. Next, on calls. So you have come across calls now. So your fifth entry for recording calls amount due. So for recording share first and final call money due. So what is the entry? Share first and final call account data to share capital account. Next, you are going to receive the share first and final call money. So for recording the share first and final call money received, so your entry is bank account data to share first and final call account. So once it is due, next entry is for received. Next, for recording forfeiture of shares. So suppose if there are shareholders who have not paid any of the amount in any of the stages, so their shares is going to be cancelled. So which is called as forfeiture of shares. So what is the entry? Share capital account data to forfeited shares account to concerned share call account. So you'll learn about this when you solve the problem. So time being, remember, so what is the entry for forfeiture of shares? Share capital account data to forfeited shares account to concerned share call account. Next, after forfeiture, you are going to reissue that forfeited shares at a discount. So what is the entry? Bank account data, forfeited shares account data to share capital account. So this is for reissuing. So this is the entry for cancellation. After cancelling those shares, so those shares has to be reissued again. So it will be reissued at a discount. So what is the entry? Bank account data, forfeited shares account data to share capital account. And the last entry is for what? Your forfeited shares account, the remaining amount has to be transferred to capital reserve. So what is the entry? Forfeited shares account data to capital reserve account. So these are the 9 important entries what you have to learn. So we shall see the further session where we are going to solve the problem so that you can clearly understand where the amount has to be recorded. But you have to thoroughly go through these journal entries. So in my next session, we shall directly solve the problems on issue of shares. So my dear students, hope you have understood today's session. So today we have learnt what are the accounting treatment that we have to make and what are the types of shares and the difference between equity shares and preference shares. See you all in my next session with the problem on shares. Till then, take care. Thank you.